Hello, welcome. In this lesson number 2, we will be answering few questions on financial mathematics for the grade 12s. Let us first start by reminding ourselves of the equations that we need to use for financial mathematics grade 12. To know which formula to pick best, you just have to visit lesson number 1 because there we are dealing with the best ways to select a correct formula. The first one, if you remember well, we are having a formula, and the formula is the ones off category, which is the simple interest formula. So you can see that we have a simple interest formula, and then you have a compound interest formula. So these two formulas, when you look at them, they both deal with interest, but they are falling under the ones off categories. And we have the simple decay or the straight line depreciation. Going further, we have the reduced balance method. And then on the continual payment, which is the annuities, we are having the future annuity, and we also have the present annuity, or also known as the loan. So just to know which formula to pick, as I said, visit lesson number 1. But to get to the calculations, let's go on with the lesson and see how we can actually calculate. And remember, for you to best choose the simple interest formula, you'll read the question and understand that it is where a payment is done only once for that specific period. And in the question, there is no mentioning of any inflation, there is no mentioning of any population growth, and there's no mention of any compounded after the percentage. For example, if we are having 7.5%, they say per annum, then they do not say compounded. They just leave it like that. Then we know that it is a simple interest formula. And if it is a compound interest formula, you will either see the word inflation. Once you are calculating inflation, we use compound interest. Or you will see the weight of population growth, when the population of a specific town or the population of a specific insect. Or you will see after the 7.5%, if you are given the 7.5% per annum, after the 7.5% per annum, you will see that it says compounded. It could be monthly, it could be yearly, it could be any, but the minute you see compounded, you know that you have to use the the compound interest formula. And you know that first it should be a once-off formula, a once-off category or a once-off payment. Then once you see compounded, you know that it is the compound interest. So let's get to the questions now. So looking at question number 1, first I suggest that when you approach questions, you read the question 3 times. 3 times. And why do we read it 3 times? Is specifically, first time is to choose an equation or a formula. And then for the second time is to read it to collect the data, to be able to know what to substitute into the specific formula. And for the third time is to be able to make a conclusion, because at times we leave questions unconcluded or without conclusions because we only read the question once or twice. So let's read it for the first time and identify, is it once off or is it a continual payment? So they say John is planning to purchase a house in 10 years time. He deposits 500 rand every month into, so the term every month simply answers our first question. Is it a continual payment or a once-off? We find out that he is paying every month, therefore it is a continual payment. In the continual payments, there are two formulas. So therefore, two formulas in the continual payment. If you were to just reverse back and see, we are having what we call the future annuity and also the present annuity. So we just have to find, did he pay like that with the goal of getting an amount in the future or repaying an amount that happened actually just now? So we notice that if we continue with the question, it says he paid every month into an account that offers him 10.5% per annum compounded monthly. It says calculate how much he will get at the end of 10 years. That means it says how much he will get, meaning he will get the larger amount in the future. We will get the larger amount in the future. So we are actually looking into the future. He will be getting that larger amount in the future. It means that the equation that is suitable for this calculation will be the future annuity. The future annuity. So this is the formula for the future annuity. It will be the future annuity. So now we just need to know by a collection of data what is needed and what is given. So we see that on the future annuity we need F, which is the future amount, we need X, which is the constant amount, we need I, which is the interest rate, and we need N, which is the number of payments. So F, they are looking for it because now we need to read the question for the second time. Remember that for the first time we were collecting information to identify the equation, the correct equation to work with. So now we have the equation, which is the future annuity formula. So what we need now is to read the question again to collect data. So they say John is planning to purchase a house in 10 years time. 10 years. He deposits 500 every month. That means the constant amount is 500. And into an account that offers him 10.5%. So we are dealing with 10.5%. 10.5%. And then they said per annum compounded monthly. So we can just divide this by 12 right away so that we don't forget. And then they say how much will he get after 10 years, at the end of 10 years. So it means on our number of years or number of payments, we will have 10 years multiplied by the compounding, which is 12. And this is giving us a strong 120 payments. A strong 120 payments. So this is what we have on the data. Now, the only thing that we are left with is to substitute the information given into our equation. So for example, X, we found it to be 500. And then we have 1 plus I, we found it to be 10.5%, which is over 12. So we have to divide it by 12. And our N at the top there is 120. And then we complete the formula by a minus in that one there. And then everything is all over. It's all over. The interest, which is 10.5%, 10.5% over 12. So it's a matter of getting the answer now, of which the answer from my calculator is successfully 105,000. So it is 105,407 rand 41 cents. So just to write the one properly so that it can be visible that it is 105,000. So this person at the end of the 10 years will be expecting this much. So the question was saying, now we read the question again for the third time in order to conclude. It says calculate how much he will get at the end of 10 years. So now we can make a beautiful conclusion, at the end and say he will get 105,407 rand 41 cents. So that is it for the first question. Now, a few things to remember. When you punch this entire arrangement in your calculator, you must not forget the most important thing, which is the percentage. So you have to write percentage, which is on your Casio calculator. You will say shift and then press the open bracket. And if you don't want to press the percentage, you can simply convert it aside. Right here, you can convert it and say 10,5 divided by 100 then you divide again by 12. So then it will give you this entire arrangement. So at the end of the day, you must get this amount. You can try it on your own. Now, question number 2. Remember, we have to read it 3 times. First time, we have to read it to understand what formula it needs. And second time, we need to read it in order to collect the data for the formula. And then on the third time that we read it is to make a conclusion. So it says Buddha is a mechanic at XYZ. He wishes to open his own company. Thus, after winning lottery, he deposits 500,000 into an investment account that offers 5.3% per annum. How much should he expect in 5 years' time? Now, if you notice, there is no mention that Buddha paid every month or every term. Rather, they only say he deposited 500,000 into an investment account. That means this is a once-off payment. Now, is it going to be interest or depreciation? So we are offered a specific interest here, which is 5.3% per annum. It means it should be interest because he deposited the money into the bank. It cannot depreciate. That's our understanding. Furthermore, because it is interest, there is compound interest and simple interest. Which one is it? To identify which one it is, we have to check now, is there any inflation mentioned? No. Is there any population growth mentioned? No. Is there any compounded after giving us the interest rate mentioned? For example, did they say 5.3% per annum compounded, specific compounding? No, it means now it is a simple interest formula. So let's go on and write the simple interest equation. Simple interest, and then collect data based on the simple interest equation. Based on the simple interest equation. So this is what we have. So A, which is the future amount, P, which is the present amount, I, which is the interest rate, and N, which is the number of years, because this is interest now. So we read the question again to collect the data. Let's read it. Buddha is a mechanic at XYZ. He wishes to open his own company. Thus, after winning lottery, he deposits 500,000. So the first thing that he did, which is the present amount, was to deposit 500,000. So let's go on and see. It says into an investment account that offers him now for substitution's sake, we are having A, which is unknown. Keep it as A. The P is 500,000. So we're gonna put 500,000 rands. 1 plus the I is simply 5.3%, of which you can choose to write 5,3 over 100. It's a choice. And then we multiply it by the number of years, which is 5 years. And then at the end of the day, we will get an amount of 632,500 rand. But this is not the final answer. We should not end here. Remember, we need to read the question for the third time for the sake of conclusion.